Ladies and gentlemen, traders and investors, a very warm welcome to our channel Polo Vega. On today's video, we shall change the format of our presentation and shall shortly touch upon the markets which have already flowed back to a normal level, or some of them have actually made a new high after crossing their all-time highs like the Nasdaq 100 and the S&P 500. Also, Nikkei 225 has been kissing its all-time high, whereas the Hang Seng, the DAX, and the FTSE have also managed to establish higher lows and higher highs. And the VIX is very much back into normalcy. So we do not need to spend too much time analyzing the indexes or the stock market, but instead today we shall talk about the disinformation or the misconception that is being spread into traders and investors by agents and influencers and some people to attract them to the market without having enough and correct knowledge about different kinds of financial instruments. On today's video, we shall try to start talking about options, which are a derivative with an underlying asset, and they form a very important mode of investment or channel of investment for all investors and traders in multiple ways. So before we go on to discussion on this topic of options, we shall talk about the markets a bit, about the currencies, the US dollar index, the different indexes, a bit on gold and the energy market, and then we shall come down to the options. Disclaimer/disclosure. The contents of the presentation are for information purposes only. The material has been obtained or derived from sources believed to be accurate, but we do not guarantee its accuracy. The presentation is the 4th of a series of interactive videos aimed at educating our viewers, and we would like to warn all our viewers of the risk associated with the business of trading and investment. Securities investment and trading is a highly risky business, and there exists a possibility of partial or total loss of investment. The ideas and opinions in our video are solely based on our analysis of the market. We do not advise/recommend/guide anyone to take any trade based on the contents of this video, and we do not take any responsibility for partial/total losses arising out of trades based on the contents of this video. Traders and investors, the chart that we see in front of us is that of Dixie, or the US dollar index, and we're looking at the daily chart. From what we've seen in the last few weeks and over the past few months, the index has been moving in a range bound area between 95.459 and 100.391. It's now been able to break this range ever since started this range bound journey from April 2025, and we have seen many other indexes, commodities and asset classes make new highs or lows, but the US dollar index continues its range bound journey, and on Friday it closed at 98.05. Traders and investors, the chart that we see in front of us is the of XAU/USD, is the gold based ETF, and we're looking at the daily chart. We've been visiting this chart over the last few weeks, right from the beginning of the new year, when it made its all-time high after touching 5600 and then fallen back to 4393 at the beginning of February, followed by another low at 4100 sometime during the 3rd week of March, and then it managed to go back up to 4900 and made a new lower high as compared to its previous lower highs made at 5400, followed by 5191, then 5015, and now we can see it flirting with the level at 4900, but if it manages to gather some strength, we can see that there could be a range bound movement between 4500 and 4900, depending upon how the situation with the ceasefire between Iran and US turns out during the forthcoming weeks. We can see if this particular asset class tries to break down or go back up, but as of now we can see that it has been trading in very small moves, with the daily ATR coming down to nearly 100, and there have been more of dojis than any explosive candles on this chart. Traders and investors, the chart that we see in front of us is that of US oil spot, and we're looking at the daily chart. This particular asset class has shown a lot of strength during the last 3 weeks in spite of the announcement of the ceasefire between US and Iran, but the energy asset will continue to show bullishness, and there will be a lot of mojo in this particular asset as long there is no solution found to the blockade of Strait of Hormuz and the supply of oil and gas remains affected. There has to be a solution to the ongoing ceasefire discussions, and one has to be very careful if you want to partake in a trade on this particular asset class. Traders and investors, the chart that we see in front of us is that of Nasdaq 100, and we're looking at the daily chart. This particular ETF has been making new highs after new highs each week ever since the ceasefire between US and Iran was announced, and irrespective of the news coming out from the two nations, he has been printing blue candles after blue candles and has been in a very strong uptrend. Last week as well, it touched a new high on Friday and ended at about 27,801. That's the new high printed by Nasdaq 100, and it could still go up. So the only trade that we're looking at is long wherever we get a chance, maybe on the lower time frames. If you look at the 400 or the 240 hour minute chart, then there is an area here between 27,538 with a stop loss going between below 434, and otherwise if want to be safer, but you could miss out the trade if you want to get into a long on this particular asset class, as it has been very bullish. But a safer zone is about 27,108 with the stop loss going below 26,902. Traders and investors, the chart that we see in front of us is the of SPX 500, which is the ETF on S&P 500, and we're looking at the daily chart. It has been strong and been following a very strong uptrend ever since the announcement of the ceasefire between Iran and US, but it's not as strong as the Nasdaq, and in the last 2 weeks it's been more of a sideways trend than an uptrend, although it has managed to break its old all-time high and print a new all-time high at about 7174 to further break it on Friday and reach a new one at 7272, but then it reversed all its gains and practically ended up as a red candle or a bearish candle at 7221. Therefore, the strongest of the indexes is Nasdaq, followed by S&P 500, and then we've got the Nikkei 225, which is also flirting with its all-time high, but the rest of the indexes have not been as strong as these ones. Traders and investors, the chart that we see in front of us is that of GER 30 or the DAX 30, and it is the daily chart that we're looking at. Why we're looking at this chart is just to show that this particular index, as well as the other Asian and European indexes, are not as strong as the S&P 500 or the Nasdaq 100. We can see that after reaching a high of about 24850, it has been moving sideways. It tried to come back down into this demand zone between 23500 and 24000, but it has now managed to break out of its earlier high or even reach the all-time high that it had reached in January this year. So as of now, we can see that the DAX is kind of moving sideways as compared to the American indexes. Traders and investors, the chart that we see in front of us is that of USD JPY, and we're looking at the daily chart. The only reason why we're visiting this chart this week is to show the intervention by the government on Thursday of last week, where the Bank of Japan did try to interfere and bring down the value of USD/JPY all the way back to 155 after it had reached the high of 160.68. Therefore, one needs to be extremely careful, even if the asset class was going sideways for the last few weeks, but you need to be very careful if you want to get into a long, as there could be an intervention by the government at any point of time in this particular currency pair. Traders and investors, the chart that we see in front of us is the USD slash GBP or the cable, and we're looking at the daily chart. This has been the strongest of the currency pairs in spite of all the strength shown by US dollar during the US-Iran war. The GBP USD currency pair hasn't taken a dip. It traded sideways for a while, but it has managed to make a new high this week after touching 1.3653 and then closing at 1.35671. There is a lot of strength in this particular pair, and we could see it breaking out of the supply between 1.3715 and 1.3618. That's the immediate supply zone on top of the current price, and then there is another one which is at the recent all-time high of this particular year, which is at 1.3863 and 1.38. That's a supply zone on the higher side, but it needs to first break above the immediate supply between 1.3617 and 1.3715. However, with the strength shown by this pair, one could still try to go long if it goes below 1.35 on the lower time frames and try to make use of or join the uptrend that it has been following. It is on the 4-hour time chart. One can see that it has made two red candles, and there is a nice area where one could enter to join the uptrend at 1.34825 with the stop loss going below 1.3445. That's the trade that we've got on the cable, and this would allow us to certainly go all the way up to 1.37 or even higher if the uptrend continues. Ladies and gentlemen, traders and investors, as we'd spoken on the beginning of our presentation, that we shall be talking about options on today's video. And before we go on to talk about this particular derivative, let's first ask ourselves the question as to why do we need to engage ourselves into trading or investing into derivatives rather than directly trading into the underlying asset through the same brokerage channels or through the same institutions that are trying to offer us these financial engineered instruments to trade the assets which we are not trying to trade directly. The first thing that all of us need to know, that the seller of any of the financial engineered products has to have a profit before he or she tries to sell the product to the customer. They always try to lure the investor to get higher returns and try to show that the risk has been almost eliminated by the inclusion of these exotic instruments which could otherwise not be done directly by the customers. But one needs to be very careful in understanding the actual risk to reward ratio before we put our foot into trading or buying any of these financially engineered instruments. The second part is that the free or the risk-free rate of return as offered by banks will always be the safest way for one to get an income on their savings or their cash deposits wherever they keep. In order to get higher returns than the risk-free rate, you must assume some kind of risk which could allow you to lose as well in case the direction of the trade doesn't go right or doesn't go in your favor. So the investor or the trader must be ready to take the risk of loss below the safest way of earning a return on their deposits or on their investments if they wish to try their luck onto any of these financially engineered instruments. Now we shall talk about options. Options, in simple terms, are a way of controlling a very high value asset with a nominal fee known as the premium for the option. It allows us to control a large value asset by paying the premium to the broker and fixing the price of the underlying asset at a future date. The price at which the option is being bought or sold is called the strike price, and there are two kinds of options. The first one being the European option, where the buyer of the option is allowed to exercise the option only on the date of expiry of the option contract. And the second one is the American option, where one can exercise the option anytime before the expiry date of the option. Now, as we speak and as we say that we are allowed to control a very high value asset at a nominal fee, this means that there is a risk factor involved, because otherwise nobody is going to allow us to control a high value asset at a small price. So we must know that we are trying to speculate the price of the underlying asset for a future date, which could go higher or lower than the strike price. And if we are fixing the price at an earlier date and the price is not in our favor on the date of the expiry of the contract, then the option expires without the transaction taking place, and the buyer of the option loses the premium paid to the broker or the agent or the financial institution who's trying to promote the option contract. Options, by definition, are a contract which gives the buyer the right to buy or sell an asset at a particular strike price at a future date, but there is no obligation for the buyer of the instrument to buy or sell the underlying asset if the price does not favor the buyer of the asset on the day of expiry of the contract. This, in other words, means that if the price on the expiry day is not favorable to the customer or the buyer, then the option expires worthless and the buyer of the option loses the premium paid to the seller of the contract. So therefore, there are two sides of the option contract. The first part being the buyer of the option contract, and the second part being the seller of the option contract. Options, by definition, are a contract which involve two parties, which are buyer and the seller of the option. The buyer of the option has the right but not the obligation to exercise the contract or exercise his right on the day of expiry of the contract or earlier in case of American options, and if the price of the asset is favorable to the buyer of the option. The seller, on the other hand, has the obligation to deliver the underlying asset or the difference in the value between the current price and the strike price if the exchange allows the seller to do so. Therefore, options are basically a privilege for the buyer, and the risk taken by the buyer of the option happens to be the premium that he pays to buy the option. In other words, the buyer's risk is limited to the amount of money that he spends in buying the option, whereas the seller's profit is limited to the amount of money that he gets when he sells the option contract for a premium, but his risk is unlimited because the price could reach any point above or below the strike price as agreed on the option contract, and the seller or the writer of the option has to fulfill his obligation by either delivering the underlying asset or given the difference of the price at the time of expiration of the contract. Options are of two kinds. The first one being the call option, where the option buyer has the right to buy the underlying asset at the strike price at a future date, but he doesn't have an obligation to buy the underlying asset at the strike price if he doesn't want to do so, or if the price is not favorable to him. The second one is the put option, which gives the buyer of the option the right to sell the underlying asset at the strike price at a future date as agreed on the option contract. And once again, the buyer of the contract does not have an obligation to sell the underlying asset at the agreed strike price on the future date of expiry. Therefore, from what the option contract is designed, we can see that there are two sides of risk and there are two sides of profit. In case of call options, The buyer has a limited risk, but his reward is unlimited. If the price goes in his favor, there is no limit to the amount of profit that he can make. Whereas in case of the call option, the seller's profit is limited to the premium that he gets from the buyer of the contract, but his risk is unlimited because of the fact that he would have to pay the difference of the current price and the strike price if the price happens to be in favor of the buyer of the call contract. And that could be any amount depending upon where the price reaches on the day of expiry of the contract. In case of a put option, the buyer of the option again has the right to sell at any value. Therefore, once again, his profit is unlimited if the price happens to be below the strike price, and that could be indefinite. Whereas his risk is the amount of premium that he pays to buy the put option. And for the seller of the put contract, his profit is limited to the premium that he gets from the buyer of the option, but his risk is again unlimited, where he pays the difference of the price that could be any amount between the current price and the strike price of the underlying asset. Or otherwise, he may have to buy the underlying asset after the expiry of the contract if it expires in favor of the buyer of the put contract. We shall continue with our discussion on options on our next video as well, because there's a lot to be discussed with options before we decide into trading or using options in our portfolios as a hedging strategy, or try to make profits out of buying or selling options. We hope that our presentation has been informative and exciting enough for you to come back and watch all our videos every week. We shall continue with our weekly commentary and analysis, and shall be touching upon events which are the highlights of the week, and shall talk about interesting asset classes each week. We shall continue with the discussion on options in our next few videos until we start talking about specific options on various exchange traded funds. If you liked our video, please give us a thumbs up and press the bell icon underneath to subscribe to our channel Polo Vega and watch all our videos. You may also visit us at our website www.polovega.com or get in touch with us through our Twitter handle @PoloVega. Please keep saving, investing, and getting wealthier until we meet next. We thank you for watching our video, and please like, share, and subscribe to our channel Polo Vega.